In today's video, I want to talk about something called I bonds. Now, what does the I stand for? Inflation. Inflation is a hot topic. Here we are at the end of 2021. It's been a major issue because it's something that's been pretty dormant really over the last decade and has now started to rear its ugly head again. Now, the interesting thing about I bonds is they've been around for a long time. They go, our data suggests, I think they go all back till 1998. But no one's really looked at them because they've sort of been, as my colleague says, a nothing burger. Now, the thing about I bonds now is with inflation really on the rise, the interest rate that they pay has made them much more attractive. So let me walk you through an example. So first of all, I bonds are issued by the U.S. government, and you buy them directly through the U.S. Treasury. You don't buy them through E-Trade or your Schwab account or Fidelity account. You got to buy them directly through the U.S. Treasury. And right now, if you can believe it, the interest rate on I bonds is 7.12%. Okay? Now, I want to be clear, that rate of return is a component, it's made up of two components. The first is a fixed rate. And right now, that fixed rate is 0. The second part of that is the variable rate, and that's the interest rate component, or excuse me, the inflation rate component. Okay? And right now, it's this 7.12%. Now, it's calculated in 6-month increments. So I'm a little close there. I think it's half of that. 3.5% calculated semi-annually. But here's the thing. When inflation is recalculated every 6 months, this number changes. And we multiply it times 2 to get what you would receive in interest for the entire year. All right. So we know right now from November to April, if you buy any of these I bonds directly through the Treasury, 7.12 is the annualized rate of interest that you get from the bonds. And technically, they're broken down into 6-month increments. Right now, it's from November to April, and then from May to October will be the next rate. So interest rates can go up and down, and the factor that they're using is, I'll just put it over here, CPIU. Okay? That's CPI Urban. Now you can find this online. We'll post the link in the notes below. But what's interesting is that I bonds, this is not something that you can pair with your stock portfolio or your Bitcoin assets or anything like that. This is actually for your really safe and secure money. Now, if you go to a bank, CD might pay you 1%. Money market, I mean, we all know it's laughable. I mean, if you get 1%, it's probably half of that, right? 0.01%. This is on your safe money, okay? Now, the government is issuing bonds that's backed by the government, which you could arguably say is the safest investment that you can get. You're at a much higher rate here. Now, there's a few things or characteristics that come with it that make it unique. Number one, as I said, you can't buy it directly through your brokerage accounts. You have to buy it through the website Treasury Direct. Let's see, hope you can read the handwriting there. TreasuryDirect.com. Okay, you need to set up an account. It's kind of like a digital wallet. You can put in your bank account or routing and checking number, and you can do a one-time purchase. You can do monthly purchases, whatever it might be. Here's the other thing. There's a limit. You think, well, geez, why wouldn't you put as much money as you had in that? That's a pretty good rate of return for safe money. The limit is $10,000 per person per calendar year. Now, as I said, as we film this video, it's the end of November in 2021. So you could buy $10,000 for yourself now and maybe another $10,000 for your spouse. And then in January 2022, you could do the same again, $10,000, $10,000. You could arguably get $40,000 into this high-yielding, safe, secure investment pretty quickly. So, to recap, there's 3 things that we really like. You've got the safety of your principal, right? The principal is guaranteed by the U.S. government. You've got the high yield, which is just another way of saying the interest that it pays is far greater than what you're going to get on similar types of investments. And the third thing is it is giving you ongoing inflation protection. Because if this inflation number, when the Economics Bureau announces it, goes up, meaning inflation is going up, that means this interest rate that they pay is going to go up. So instead of having cash lying around, not earning any interest, or making any money, it's actually being eroded by this inflation. Okay, here's one way to combat that. The risks, if something happens, changes economically, and all of a sudden inflation goes way down, that just means that this interest rate is going to go down. Still got a long way to go before you get to these boring rates over here. Okay, so let me just talk. One last thing I forgot to mention is about the liquidity. So when you buy these bonds, you've got to hold them for 1 year, okay? They want you to hold them for 5 years, but anytime after 1 year, you can sell them. Now, if you sell them after 1 year, but before 5 years, they only credit you, they won't credit you the last 3 months of interest. And let me just give you an example. If you held an I bond for 18 months and sold it, you would get 15 months of credited interest, okay? I don't even think that's that big an issue, because when you're comparing it to the rates that you'd be getting on another investment, your opportunity cost is still much, much greater with this investment. So there is the 1 year holding period, and then there's that wrinkle if you sell it before 5 years. Anytime after 5 years, you just get the accrued interest. The other thing that I want to mention is it doesn't pay the cash dividends along the way. So let's say you put in $100,000. After 6 months, they credit you half that interest, which is this rate here. Okay, so $100,000 would be, I'll kind of draw it up here like this. $100,000 months 1 to 6. Is that too low? Yeah. It's too low. All right, let me just erase it and I'll move it up a little higher. Months 1 through 6, and you put in $100,000, you get credited this 3.56%. Now, this is the current rate for these bonds that are being issued right now from November to April. So your account value would be $103,560. All right. Now, in months 7 through 12, this rate is going to compound at the second half of this 3.56%. So it's actually going to be a little bit more than 107,120. The point I'm trying to make here is that the interest accrues on a 6-month basis. Okay, so you're actually getting additional interest on your previous money, and that's a good thing. That helps with compounding. So the final thing I'll just say is I think this works really well for emergency funds. Okay, yes, sometimes emergency funds, you want to have things liquid. So if you don't have any other assets that you could use over the course of a year, well, then you might want to hold those back. But any additional funds outside of that, you really want to consider some I bonds here. You can go to treasurydirect.com and buy them if they make sense for you. So short term, but you know what? They can even work for a long-term investor. And typically, this would work in a scenario where maybe you have a goal, an earmarked goal. Kids going to college in 8 years, something like that. Maybe you carve out some funds and say, okay, look, I'll earn this rate of return, assuming inflation stays the same or goes up, for those 8 years. Now, remember our video on Rule of 72. If you take 72 and you divide it by your interest rate, I'll just make this 7 to make it easy. Your money's going to double roughly every 10 years, okay? So, if you were putting away for college, you could get a nice rate of return and essentially double your money at this rate of return. So that's what I have to say about I bonds. It's something that really we haven't seen in a long time because inflation's been so low. So while we're all kind of belly aching about what we're paying at the gas pumps or at the grocery store, those are hurting us. But it's helping an investment like this, and it might be something to consider. Thanks, and we'll see you in the next video.